No bears were harmed in the making of this video. Please go donate to the QQQ Bear Extinction Fund by pressing the buy button inside your brokerage on ticker QQQ.
But if you don't, I will look for you. I will find you. And I will kill you.
You. Yes, you. You want to understand what's going on in the stock market, but you're too lazy to read the book or do your own research. Well, this video might help you. And hell, for those of you who have read the book and do your own research, this might be even a little bit fun. So let's keep the comments as toxic as possible. Do the thing. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, a very interesting day of trade, a very green day of trade. Interesting nonetheless, a lot of stuff we do need to talk about. Now, today's rally was led by financials. They were very, very green and one of the only sectors that didn't have major red components apart from Chubb insurance right here. Whereas in every other sector, we did see major players in the red, stuff like AMD in the tech sector, as well as Apple, Google, pretty much flat. Here in healthcare, Johnson & Johnson, Merck, in energy, ExxonMobil. So there definitely was red today, but stocks were very green. We saw Nvidia up 4.72%, Microsoft up 1.24%. They really led the charge along with software. Software was very upbeat. It's probably had to do with Uber's employment report. Even defensive sectors, stuff like utilities and consumer staples, were very green today. And across all segments, smalls, large, and mids, everything was green. Smalls were the best performer. They outperformed mid caps, and mid caps outperformed large caps. Large caps were very green. Growth really won today, and value was up 0.8% in the large segment. And we do need to talk about this because this large value space is where we have a lot of our defensive stocks, and a lot of these defensive stocks were actually positive here today, which is very interesting. What you really want to see after a market has bottomed is actually defensive stocks, stuff like utilities, consumer staples, fall, while cyclical stocks, stuff like tech, financials, rise. Now, we did see financials rise, but this probably has to do with rate cuts. Why do I say that? Because real estate actually beat financials handily, up 2.3%, the best performing sector. What you also have to understand is that when rate cuts come into view with the revenues that real estate generate, maybe not so much the office space, real estate probably is a defensive sector in this type of environment. I think investors are going to be far more inclined to hold real estate over something like energy, materials, or industrials, especially if we are going to get 4 rate cuts as priced into the market right now by December. So that's why we saw real estate and financials, the best performing stocks. They're very rate sensitive. They're going to benefit the most. And then we saw tech up 1.4%. A lot of the market flows are driven by tech, so it's very natural to see them up at the top. But the fact that we saw utilities gain, staples gain, healthcare gain up 0.5%. Yes, they were at the bottom of the sector analysis chart, but the fact that they gained tells us that there's still a little bit of market jitters going around. And while liquidity did pour into equities, what we did see towards the end of the day was actually a very brutal sell-off. All of the major indices, the equal weight, the S&P 500, the Nasdaq, IWM2, were up about 2.5% leading into 230, and then they came off their highs in a very significant way. And while we saw equities follow through into the end of the day, we didn't see bonds do the same. Bonds actually made lower lows into the end of the day, telling us that there was some dedicated equity selling right here, and it was in rotational flows. Very concerning things that we do need to pay attention to. Equities did sell off at the end of the day in a very big way. This is a huge sell-off that didn't coincide with bonds ripping to the upside or yields falling. And we saw utilities, staples, defensive stocks gain, leaving the market on very uncertain terms. We don't know if this is the bounce that's going to take us back to all-time highs, or if this was a dead cat. And tomorrow we need to pay attention to utilities, what's going to happen with utilities, staples to defensive parts of the market, what's going to happen with the rate sensitive stocks and the market in general. If we tomorrow go ahead, take these highs, see utility staples sell off and then move higher, okay, it's on. We're back on. However, if utilities and staples continue to remain strong tomorrow and we see weakness in the large components in the large part of the market, that probably means this is a dead cat. And with this week being a light week of economic data, we're all just trading on the technical aspects right now and sentiment from last week. You know, Japan's roller coaster valuation, anxiety over the US economy, and inflation and rate cuts. Those are the four things driving sentiment right now. And diving into the charts, you can see a green day across all of the major indices: the S&P 500, the Nasdaq 100, the IWM, the RSP, midcaps, the SP 600, the S&P 500 itself, growth, value. These were all up about 1% on the day. We did see commodities take a hit. Gold was down 0.84%, silver down 0.99%. The dollar did gain. Yields did gain too on the day. The 10-year yield was actually up 2.74%. The 30-year yield was up 2.65%. And even the 2-year yield up 1.5%. And the yield curve is almost uninverted, especially the 2s and 10s. You can see the 2-year yield at 3.992%, the 10-year yield at 3.9%. So one of two things has got to happen. The 2-year yield has to fall or the 10-year yield has to rise. And as long as it stays below this 4.19 level of the 30-year yield, you should see a very balanced yield curve between 2s, 10s, and 30s. Now let's dive into the S&P 500 and look at these levels. These are our gamma levels. 5,500 is the gamma resistance. This is the put support. And then this is the gamma flip zone, this yellow line. And very, very interesting. Almost bottom ticked the 5,100 level right here. Bounced, had some follow through today, all the way up to the 5,300 area where we actually found resistance. Shorts came in a very big way at the gamma flip zone. They actually came in the right spot to keep us in negative gamma. Very interesting dynamics. So yesterday I did go out and say that what we need to wait for is the market to get to 5,300, build some support up here, and then make our next move higher. We did get to 5,300. We were in positive gamma today. However, we did not build support. And this support, I'm talking over a couple of days, not just an hour of trading and then a move higher. That could happen, but what we really want to see is support above the 5,300 area and then a move higher. We did not see that today. If we actually dive into the 5-minute chart, you can see we actually ticked above the 5,300 area for just a couple of minutes, maybe an hour or so. We went positive gamma. Then the bears came in a very big way, took us all the way down back to the 5,250 area. So we are still in negative gamma in the context of everything else going along. So what does that mean? In negative gamma, we follow the trade plan. And the trade plan tells us that in negative gamma, our target zone is the 5,100 area. And until we actually go ahead and break the 5,300 area, that's when we would look to the 5,500 and then some of these key levels. At the same time, what we actually did fail to do on the run up to this 5,300 area right here is that we didn't actually go ahead and take back any key levels. For the gamma flip retake to be of any significance right here, I think we would need to go retake this 5,350 area, maybe find some price action at this area right here where we closed on Friday. That's when the consolidation above the gamma flip becomes significant. But as it is right now, bears did show up in a big way in the place they needed to show up, and that is concerning, coupled with the fact that look at the S&P 500 after hours, down 0.46%. Same here with growth, down 0.53%. IWM and RSP are also all in the red. And yes, it is a lack of liquidity in the after hours, but that is still movement in the market that we can pay attention to, and it's something that we need to look at. A little bit of bearish sentiment here in the after hours in the context of having the 5,300 gamma flip sold, not looking too good, but a lot's going to be dependent on where these reposition itself. We want to see, is the gamma flip actually going to move down with regards to where we closed, maybe closer to the 5,280, 5,250 area? So going to stay at 5,300, and what's the put support going to do? I think if these two stay where they are, this is probably our trading zone for the next couple of weeks, unless we break above or below, and then we go from there. I think constructive price action for both the bulls and bears. Pick your poison and have conviction. Now, looking at sentiment, I know I normally show you these sentiment indicators on the weekend video, but we didn't get a weekend video this week, but it's still good to look at these. Now, this is sentiment for last week, Monday to Friday for both of these indicators. So it is a bit dated. It's not reflective of the sentiment this week. Still great to look at, and it's really good to track them on a week-to-week basis. And what we saw with BOFA's bull bear indicator is that it actually fell to the 6.6 region from 6.9. 0.9. We were actually getting to the real frothy levels the week before last, when this was very close to the 7 region. The Goldman Sachs sentiment indicator is still seeing us at or near stretch positioning, now just below this mark right here, but let's be honest, we're still above the 0 line, which means sentiment is still a bit frothy. And while both of these indicators are still in very bullish sentiment here at 6.6 and 0.9, we actually want to look at the trend. They're trending this way, and what these indicators are telling us is just to be cautious. Now guys, let's put 2024 into perspective. We have only seen an 8.5% pullback in the S&P 500, an 8.5% drawdown on a closing basis. Now we did get to 10% on a wick basis in yesterday's trade, but close to close we've seen an 8.5% drawdown in the S&P 500. The average drawdown in the S&P 500 is 14.2%. This green line right here is the average pullback. We are still tracking an above average here. This can change, absolutely, but I just wanted to put this into perspective. Volatility we're seeing this year, yes, it's sharp, yes, there's probably growth concerns, I get it, but the truth of the matter is we get that every single year. We got that last year, we got that in 2022, we got that all through 2021, 2020. It's just a normal part of the market, and volatility is the price you pay for the outsized returns you get in the S&P 500, and buying the dip is your best bet. This is some very interesting data from Goldman. When the S&P 500 pulls back 5%, 3 months later you could see 6% returns. 6 months later you'd see something like 7% returns, and upward of double-digit 10% returns 12 months later in the S&P 500. So guys, buy the dip, dollar cost average. I really do believe we're going to shake this off in the near term, especially heading into a Fed cutting cycle. And if you want even further outsized returns relative to the S&P 500, you can look at utilities, comm services, staples, and healthcare. These 4 sectors, 3 months before and 3 months after a Fed cutting cycle, tend to outperform. We could see excess returns of 10%, 5%, 5%, and 3% respectively, with financials also putting out great returns, the tech sector relatively flat, and then industrials, materials, discretionary, and energy, so the very cyclical parts of the market, actually seeing negative alpha in comparison to the S&P 500. So for the next 3 months, assuming we get a cut in September, this is where you want to be positioned if you want outsized returns relative to the S&P 500. But if you're happy with the average, buy S&P 500. So guys, earnings today, actually a very big day of earnings. Uber's earnings, this is actually a stock I've been doing a lot of research into. Very good. They were up 10% today. Fantastic earnings, margin improvements, beating the top line and bottom line. Celsius, you know what? I didn't think their earnings were that bad, but it's very clear that the inventory tailwinds are behind them. Fubo TV, another mixed bag. Not a lot to love, but I think trading at a very attractive valuation, if you ask me. And they actually have a very good product. So I think, you know, if you're looking to add a small cap that could have like a 10x returns in your portfolio, this is probably one of them. After the close, we had Super Micro, very volatile price action. I think at one point up 16% and then down in the negative territory here in the after hours. Rivian, not much to say about that. Airbnb got sold off heavily in what I thought was fairly all right earnings. Wynn Resorts, very good to see real estate actually getting a bit of an upbeat action. They were green on the day. Giga Cloud saw some positive action. The company's still growing like mad. And Reddit was down 4.89% in the after hours, but I didn't have a look at their earnings. And so where do we stand with earnings so far in the second quarter? Because it's always good to track the fundamentals in the year and now just to see what we've done. And things are holding up really, really well. Earnings continue to hover between 13.1 and 12.9% right here. This actually is well above the consensus expectations at the start of earnings season. And you guys know the go. I showed you guys this almost every single week, multiple times a week. S&P 500 revenue tracking at 5.1%. Estimates at the start of earnings season is 4.6%. This is where it gets interesting, right guys? 376 companies have reported. 78.7% have reported above analyst expectations, and margins are actually holding in there. That is the quarter past. What about the quarter looking ahead? And Q3 estimates are tracking at 16% for the Magnificent Seven, 5% for the broader market. But the more important question to ask is, what are revisions tracking like? Because the truth of the matter is the market prices in future earnings well in advance, and it reacts to changes in those earnings in the year and now. and Q3 EPS sector level changes so far have not been disastrous, but we have seen more downward revisions than upward revisions, and this in turn is part of the reason why we're seeing volatility in the market in recent weeks. We could see that the S&P 500 has seen a negative 1.8% earnings revision compared to the analyst expectation. And what this pretty much means, let's say S&P 500 earnings for the third quarter was supposed to come in at 10%. After a 1.8% revision, they're now coming in at 9.82. That's what a negative 1.8% revision means. We can see that the worst performing sectors are energy, industrials, healthcare, and materials. So very cyclical sectors, but a defensive sector here in healthcare too. And then the larger market cap sectors, infotech, comm services, and discretionary financials too. They've seen mild downward revisions. Now this is the third quarter, but if the bears want to see a real sustained downtrend, what they really need to see is revisions in 2025 estimates, because this is what the market is going to start pricing in over the next couple of quarters. And we can see that 2025 revisions, and this is from July 31st, very recent, we're seeing information tech, comm services, financials, utilities, healthcare, and materials all see upward revisions, resulting in the S&P 500 seeing earnings pretty much stay flat to where they are right now, and we're only seeing downward revisions that actually matter in the S&P 500 in energy and industrials, discretionary and staples, real estate seeing very, very mild earnings revisions. Now this is a bit of a concern for those of you that don't know. Even though the energy sector might be small on a market cap basis, they contribute a whole heap to earnings. In fact, the earnings portion of the energy sector and infotech is roughly the same. They make about the same earnings. So to see a 2.4% down revision, that's actually pretty significant. And it's very clear to see why we're seeing volatility. We're seeing downward revision in Q3 earnings, but as long as 2025 earnings and earnings revisions hold up, this is just an opportunity to buy the dip heading into a cutting cycle. And for all the drama we've seen in the market, stocks acting like we're about to go through the next 2008 GFC, Goldman Sachs have actually boosted their third quarter GDP forecast to 2.6%. This is the quarter over quarter figures. So it's this blue line right here, not the green line, the blue line. You can see that they boosted their GDP forecast. And I would like to know what data Goldman is looking at for their forecast to actually go from 2.5 to 2.6% in the context of a weaker NFP as well as weaker ISM data. So very interesting to see. I'd love to know how they track their GDP. We do know that the Fed's GDP now is unchanged. We haven't gotten an update just yet, but Goldman don't see a recession. They still see robust growth for the third quarter in 2024. But we can't deny the fact that the economic data has been weak. We did see a little bit of reprieve here in July, late to mid-July. However, after the ISM and NFP numbers, we saw economic data continue to soften, and that has been the case for most of 2024. We sort of had a high here late March, early February, and we've since seen softer economic data that has supported disinflation. But when does disinflation become a growth scare? And that's what the market is trying to price in right now. But what's very interesting about economic data is that seasonally, from about March, February, all the way to August, we actually normally do see softer data, at least according to the seasonal chart right here. Now, it's not a whole bunch of data, it's just 2023, 2022, but you can see that the data came in soft in both years from about February all the way to late as August. Sort of bottomed in 2023 around June. The economic data bottomed, and then we had stronger economic data in 2023 and the same here in 2022. And let's assume this was the bottom of the US Economic Surprise Index in the US for 2024, and we actually move higher from here. We would actually just be following typical seasonality, and this means we probably can get stronger data into late October. And the same is true with initial jobless claims. Now, I do know that NFP is really the gold standard that we want to look at, but initial jobless claims, we get these week by week. And if you look at 2023 seasonality and what 2024 is doing, the rise in initial jobless claims is tracking typical 2023 seasonality. And while this is a very shallow pool of data, what we normally see is a peak at or around this area right here, and then a pullback into the end of the year. And we do know that this period from August, October, September, all the way into the end of the year, there's a lot of Christmas hiring that goes on, and that's why we actually see initial jobless claims fall off. So I think the peak or the worst economic data is behind us, or we will get it in the next couple of weeks. And then as the data strengthens with rate cuts, that's the recipe for you to buy the dip for outsized returns in the S&P 500. And then data for the rest of the week. Now, we don't have a lot. We have initial jobless claims here on Thursday, along with wholesale inventories. And then Tom Barkin is speaking. That's it on Thursday. Wednesday, we have consumer credit. And that's really it. A very light week of data after the huge week we had last week, but still a fairly hectic week of earnings nonetheless. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.